Money Vikings, how you doing? Hope you're having a great summer weekend. I want to do an interesting one with you today. I want to go through investing vehicles for beginners. So I'm going to use NerdWallet's top 5 investments that they're going to talk about. I want to talk about each one, but I hope you're having a good Comic-Con weekend. I'm enjoying some of the ancillary stuff. I walked around, it's pretty cool. But a great summer weekend to you anyway. But again, thanks for joining, and let's dive right into it. So I'm going to go through NerdWallet here, and I want to talk about what they talk about are the 5 best investments right now. And this is really an investment primer for beginners. And the reason I want to talk about this is because investing in our society and culture is made out to be so confusing, so convoluted. And you get this like Hollywood image or this Wall Street image of, you got to be some, high-powered Wall Street guy, frantic, with 3 phones and texting and doing a bunch of charting and all this like crazy stuff to be an investor. Nothing could be further from the truth. We all have the ability and the capacity to be investors and own assets. That's the bottom line, and that's the main message that I want you to remember as you're going through your true wealth journey. So with that, let's go through 5 essential investments and talk about each one. And then this might help you to decide which one is best for you. Because at the end of the day, you have to find what is best for you, what works with your lifestyle, what works with your goals, and what really allows you to sleep at night. Because some investments are more risky than others. And we just have to know that going into them. I tend to keep the riskier things a smaller percentage, and the more tried and true traditional investments a larger percentage, because I want to sleep at night. So I think it's important. All right, so with that, let's go into it. The first one they talk about are high yield savings accounts. So the idea here is very simple. You will never be able to save enough money. And let that sink in for a minute. Because of the way life works and how much we make, okay, most of us don't make $500,000, $300,000, $1 million a year. Most of us make a standard middle class income salary, maybe even on the higher end if we're lucky and we've worked hard, or we have some sort of specialized skills or whatever. There's never going to be a situation where you can save enough to become wealthy. You need your money to become a workhorse for you. Your money needs to work for you. It needs to work harder for you, and it needs to be working at night while you are sleeping, okay? So just putting it in a traditional savings account is not going to be very good. And so that's why NerdWallet talks here about high yield savings accounts. And it says, it talks about different ideas. You can go onto their website and check it out. But anyway, the idea is, with a high yield savings account, you want to at least be at inflation or beating inflation a little bit, because the reality of a savings account over time, if you're just saving, is that your money is losing buying power every single year due to inflation. That's why investing is so critical. You need to get a little higher return, and you need that to compound over the long run if you want to build true wealth. Okay, but let's move on to more interesting things. That's fine. That's a basic thing. Okay, CDs. CDs are actually paying pretty well at the moment. So I'm a big fan of CDs. What it does is it will, you can buy them through your bank or your credit union. I prefer credit unions. And you'll basically lock up your money there's different maturity dates. You can do 6-month CDs, certificates of deposit. You can do 1-year certificate deposits. You can do 2-year, you can do 5-year. And basically it will pay you every month a certain percentage. Some of these I've seen have been about 5% recently, which is pretty good historically. 5, maybe even some 6%. That has not been good prior to the last year. Like for the last 8 years, these were horrible. They were just not paying very much. But they are actually doing pretty well now. So that's a very great basic way for people to get started investing, is if they have an extra 1,000, 10,000, a lot of them have minimums, but if you have an extra 1,000, 10,000, 5,000, you can put that in your certificate of deposit, and you're going to get almost a guaranteed 5% return month after month. So those are really nice and very safe. This goes up in the starts very safe and goes kind of more risky. But we're also going to find being too safe is also risky, right? Because of inflation and time value of money. Okay, the next thing to talk about are bonds. So people get very confused by bonds. Bonds are a situation where you are lending your money to either usually a large company or the government or a local municipality. A lot of times these are things they're used, for example, when a city or a county needs to build a bunch of roads or infrastructure or build new schools, they will issue bonds. So they'll get bond money from you, the lender, and then what happens is they have a maturity date, so usually 20, 30 years. But over that time, they pay a return. They pay interest back on your money. I prefer sort of broad general bond funds like through Vanguard because there's a diversified collection of bonds in there. You can easily sort of sell them. If you're buying individual bonds, you're gonna have to do that through a broker. It's a little different, can be a little more locked in. But in general, bonds are considered safer. Now, there are different ratings of bonds. Bonds sometimes do lose money and don't do well. So they've got bonds that are lower rated and less safe, and then those that are higher rated and considered more safe. But bonds are a good way typically to get some stability and a little bit of growth, but not much. Okay, so talks about corporate bonds, etc. Okay, funds. So money market funds. I really like this here, how they describe this. This is where I like to land for the majority of my portfolio because I want it to be working hard. Okay, so mutual funds are an investment product, not to be confused with money market accounts. It talks about their best money you may need soon that you're willing to expose to a little more market risk in funds. Investors also use money market funds to hold a portion of their portfolio in a safer investment than stocks. Sorry, these are money market funds right there. Okay, mutual funds. This is what I actually want to get into. Mutual funds and ETFs. Mutual fund pools cash from investors to buy stocks, bonds, or other assets. Mutual funds offer investors an inexpensive way to diversify. You know, some of the real classic ones are the mutual funds or the exchange traded funds, which mimic the S&P 500. So what you're doing is you're buying the 500 largest, you're buying a small share of the 500 largest companies in the United States. And what I really like about, for example, that one is that it's self-cleansing. So as those companies, if some of them fail, they get pushed out of that index and then new, bigger companies, stronger companies come and take the place of it. But usually you can get a pretty good return over the long run, and you're talking, north of 7%, 7, 8, 9, 10%. But there's been years when it's gone down, and there's been years when it's gone up like 20+% as well. But I am a fan of those. Index funds. Okay, an index fund is what I was talking about. It's a type of mutual fund that holds stocks in a particular market index. For example, the S&P 500 or the Dow Industrial Average. Okay. Now, it's important to remember, these are for long-term investors, okay? And in my mind, a lot of these are never to be sold for me. I want to hold on to them and I want to derive income from them at a later date. I really don't want to be buying and selling those on a monthly or weekly basis at all. And it talks about 2024 year-to-date return, 14% for this is probably what the S&P 500, and typically a 10% annual 10-year return, 12% 5-year return. So at those kind of numbers, you're really beating inflation, right? And you're even getting ahead, which is critical. An ETF, exchange-traded funds. So I like these a lot. These are like mutual funds in that they pool investor money to buy a collection of securities, providing a single diversified investment. The difference is how they're sold. Investors buy shares of exchange-traded funds just like they would buy shares of an individual stock. And again, this is for a long-term time horizon. Now, finally, there's individual stocks. This is what I want to say about individual stocks. Be cautious when you're starting out. In my mind, individual stock picking should be reserved for a very small amount of a total portfolio, and I think it should be when someone is more along in their journey. They have all the fundamentals, locked down. They've got an emergency fund. They're automating into diversified mutual funds, ETFs, and bond funds, right, on a regular basis. They've accumulated some capital in those accounts. They have a lot of their debts under control. If all that stuff is in place, then I can understand if there's some extra money laying around that maybe there is a place for some individual stocks that you may be interested in. But I'd be cautious because yes, they can go up pretty high, but they can also crash or just not do well at all. Now, some people do, I've done this before, some people do like to focus on like dividend stocks, for example. That's kind of interesting. You're getting a yield that's based on the share price when you buy it. Some of them are 5, 6, 7%. But that can fluctuate, and again, that can be more risky for sure. So NerdWallet, I don't get anything from them. I just enjoy their website, and I just want to do a shout out. This best investments right now and where to buy them is a nice article. I think it's great for beginning folks that are beginning in their investing journey. So hope you enjoy that. Thanks for watching, and please do the whole like, subscribe, comment thing if you can. I appreciate it. See ya.